You're listening to The Preferred Way, a retirement podcast brought to you by Preferred Trust Company, the preferred custodian for all alternative investments.
Welcome back to The Preferred Way. Well, unfortunately, it's tax season. So guess what we have to talk about? Last minute tax strategies. All the things that we need to prepare for before we get to 12/31/2025 and we kiss it goodbye. So today I have Larry joining me today, yet again. We keep bringing him back. He's brought the Big Mac this time, people. So, Larry, welcome so much. Thank you for joining us. Hey, it's your analogy. I'm just stealing it for a minute. You're laughing about it. I mean, come on. Wait till they hear about the Big Mac. See how that all comes to fruition. But in all actuality, here we are again, talking about taxes. We're nearing the end of the year. And I'm really, really curious. You know, when clients come to you, it's usually last minute. You know damn well it is. And they're freaking out about all that they realize at this point, oh my gosh, I'm going to owe hundreds of thousands of dollars in taxes potentially. What can I do at the end of the game to make sure that I'm reducing my taxes as much as I possibly can before the end of the year? Is there some sort of pep talk, presentation, analogy? What do you do to prepare your clients for that end of year?
Hey, Carrie, I appreciate you having me back. It's an ongoing thing, and to really answer your question, is all the above. So there's a pep talk, there's some consoling, there's like where you been all this time, like. All my clients have our email, they have my number, so it's like, hey, like this isn't a surprise at this point. So try not to make people feel bad, but it's like we're just not going to go out and buy G wagons and stuff like that. So because I tell people, like when it comes to like, hey, I'm trying to save on taxes, there's really 5 things to really try to keep in mind. Like understanding that the tax code is made for investors and business owners, so there's a lot of my clients, so they're already in a strong position from that standpoint. But whatever tax strategy that, like I said, I'm presenting to them, I want them to understand it's not just the money it's going to cost, it potentially could cost time as well. So just understanding that, like, hey, this is going to have a personal impact to you, not just from your pocket, but also just how you, like, just life in general. So it kind of leads to number 3, don't let the tax tail wag the dog. Because yes, you saved all these taxes by doing this, but then life sucks, and then so it's like, well, was it really worth it at that point? So you really have to understand that, and which is why it's like to be reaching out to your tax advisor like all year round, as frequently as he or she allows at that point. I typically allow my clients to reach out as much as they want. And not just having meetings just to meet, but like it's actually like, let's talk about something that's coming up, like not something that's just passed. It could be too late. And then if you don't have the right tax advisor to kind of help you through this, just understand that just because they're a CPA or they're an enrolled agent or they may call themselves a tax advisor, they may not be equipped to do what you need for your type of business, because sometimes it's all niche. It depends on the strategy that they're going with, and they may not know everything. I don't know everything, but I don't sit here and try to pretend. But you try to find the right advisor for you, so that like, hey, they're asking the right questions for you, and then they're also are applying the right strategies that fit into your life and your business and your investment. So that's it. That's all I try to make sure I kind of cover those 5 things on an ongoing basis with my clients, so that they're kind of like more prepared and not having to go through this hassle every December.
Let's say I'm maybe a newer client to you. Let's say I'm not taking it all the way to the end. What kind of presentation would you give to me to say, here are the things we need to make sure we're preparing for. Here are the timelines in which we should prepare for. Here's some, quick strategies that you could use to prepare throughout the year, so that we're not at this mad dash scramble right at the end. Now, I know most of them are scrambling at the end, but I'm sure you've probably laid some groundwork for those, those folks that tend to scramble at the end to say, let's not let this happen next year. What would something like that look like? What would you present to them?
I mean, it's not the sexiest thing to bring up, but just getting your books in order, like having your financials in order, go a long way. Of just kind of knowing like where we are, like if an estimated tax payment is needed from a quarterly perspective,
Yeah.
or if you got enough payroll that's being ran, and then we can, or you may just have a lot of expense that you wasn't aware of, and there may not be any need to be spending any much money because a lot of people still think that taxes are based on your gross income. Like, no, we're based on net in this country. So it's like,
Yeah.
just make sure you keep that in mind, but you don't know that unless you have to have your financials in order. And you don't know how much money you have to spend on it because you don't want to just be taking on debt just for a tax strategy. So,
Yeah.
it's that aspect of just the boring things in life that no one really talks about. Just bookkeeping. Does your bookkeeper have to be your CPA? No, you just need like whether you're just using QuickBooks or whatever Waves or whatever software that's out there that can manually do it. It's just putting a process and get together of how to keep up with that on an ongoing basis so you know what your bottom line is.
Yeah. Constantly knowing what your bottom line is, not just the last month of the year, people.
Yeah.
And if you're utilizing software, obviously you could probably pull reporting out of that. But it probably goes beyond reporting. Like you have to have, supporting documentation, not just numbers plugged into a system. Am I correct?
Yeah, so you have to remember that the burden of proof. Well, I get the question a lot of like, how the IRS knows? Like they don't have to know. Like if they happen to pull your card and send you a notice and they're doing the field audit, like the burden of proof is on you that hey, you had this expense on your books. Where is the supporting documentation? Whether it's a receipt, whether it's an invoice, or if you're claiming real estate professional status, like where's your time log, how you're tracking that, and the details associated with that. You have to provide that to them if they're asked for stuff like that. So it's leveraging technology where it's like you're not keeping flimsy documents around.
Yeah.
Take a picture of it, scan it in, save it in a drive somewhere, and you're just basically set. Like we have a share file portal that clients can upload all their documents to. Do we look at every document? No, we don't really need to because it's really based on reasonableness. But it gives them another platform to save their stuff so that if the IRS comes asking questions, they already know where it is and not having to look for it.
It's interesting you say the reasonableness. That is what you're looking at, right? So you're looking at numbers. Are you considering whether the client has backup or doesn't have backup as a tax preparer? Or is that burden of proof solely on the individual and not the CPA as well? Talk me through how that process works.
Well,
Because I know there are some instances where you can like buy insurance for the tax preparer, those sorts of things. How does all that work? I've always wondered.
yeah, so it's always a CYA type of approach with it. So it's like, hey, well, we're looking at the top 5 expenses or whatever at that point.
Okay.
Okay, like, do we got enough support for these? Or the client just kind of just have a whole bunch of meals. Like, hey, yeah, do you have like at some point do you got receipts for all these and not just your credit card? Like, do you have all that in place because we have to monitor all that? Because yes, because we are in question because if it becomes a trend, what people don't realize with tax preparers is like, hey, they may target one particular client, but then depending on if it means that we are negligent with our due diligence of reviewing the tax return, they can then start to kind of look at other clients in similar situations. So it's pertinent on the tax preparer, the CPA, or whoever at that point who's like I say who's putting the tax return together to have some comfort that the client has support in place enough to support it if it is audited.
Yeah. Have you ever had clients just say, "Oh, just trust me, Larry. Just I have all that. It's not a problem. If they need it, I'll get it. But I'm only going to upload the stuff that you need in order to prepare my taxes." Is that a red flag for you, or are CPAs able to process tax returns based on that limited information?
Well, I have clients say that, but it's like, well, we still need they give us the financials. We're kind of just going based off the financials at that point.
Yeah.
And like I said, like we can't force them to upload stuff to the portal. I guess we could
Yeah.
if I wanted to, but it's like, well, if you say you have it, and part of our engagement letter is that you are
You
responsible
do.
for providing any
Yeah.
documentation at this point. And there may be certain items where we'll still ask for it. Like, okay, they didn't
Okay.
upload it, they couldn't find it, but it's like, hey, like, no, like I really want to feel more comfortable. You just whatever you got, $250,000 in supplies.
Yeah.
Like, okay, like
Yeah.
I
You can
need
prove
some
that to
comfort
me.
on that
Yeah.
before we move forward there. So I mean sometimes it's like I won't say a red flag, a yellow flag, because it just could be they just don't feel like uploading all those documents, which I
Yeah.
can understand.
And that's
But
okay.
yeah,
Yeah. That's
but it's like,
okay.
hey, but do you at
That's
least
okay.
have it? Like, do you feel comfortable if the proverbial hits the fan?
That's right.
We're good to go because you don't want to be having to dig for that stuff later,
Yeah.
because if you take too long and it looks suspicious, it's best
Yep.
to kind of have it in a good, like in a couple of days of receiving a notice or receiving an IRS notice of certain documentation that they're looking for.
Mm-hmm. Yeah, absolutely. Totally makes sense. All right. Really, what I'm hearing is preparation, 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 preparation. And, really just staying on top of it, whether it's weekly, monthly, find a cadence of time frame that works for you and stick with it. Because chances are, the more you stick that out, the more you'll be able to actually create some sort of tax savings potentially. When you wait till the very end, these procrastination, right? When you wait till the very end, you forget about all the things that happened, 10 months ago, 9 months ago, 8 months ago. It becomes kind of a just like poof, it's gone. But really, some of those things could be huge tax saving advantages. So, preparation, documentation, details, sounds like those are the three things that you need in order to really move through the process of preparing taxes. Am I understanding that correctly?
You
Like,
nailed it.
get your shit together, people.
Yeah, yeah. I thought it was
Right?
PG-13, so I wasn't sure about cussing, but here we go.
It's okay. Like we're down for that here. We're real people. I mean, get it together is basically, and when you do have it together, then, employing a professional to help you file your taxes is where you're really seeing the true benefit.
Right.
Because if you're not prepared, I mean, you're not a miracle worker, Larry, right? You gotta
Right.
have the documentation to illustrate, improve, and justify some of these tax savings measures that you could potentially deploy.
Right.
So,
And more importantly, people don't realize like that goes into your business financing. If you're trying to get financing for your business,
yeah,
and if you're trying to build a business that you want to exit and sell.
yeah,
So having
yeah,
that stuff in order makes those things a lot easier to process through. Where like you just kind of create more time, you create some skepticism of your business if you're able to provide that to a
yeah.
potential lender or a potential buyer.
Services and processes. What are they? How does this business operate? Because without those manuals in place, your business is virtually worth nothing. The intellectual property, right? They're not buying you; they're buying a business. I mean, in some cases, they're buying you too, but in most cases, the goal is to buy a functioning, operating business with policies and procedures in place. Fair
Exactly.
enough.
Yep.
Okay. All right. Talk to me about some of these tax saving measures that we should all be looking into towards the end of the year, and really throughout the year. But I think the vast majority of us are looking at the end of the year as we're kind of, looking down a barrel of a gun going, oh, crap, we owe $100,000. Um, what are these tax saving measures? What should we be looking for? Is there three, five? Is there like a cardinal rule that you have out there? Are there very specific criteria that you kind of go over with each of your clients?
I would take the approach of slashing of taxes. The term slashing is key because I break it down in the sense of machetes and steak knives.
Okay.
Most likely, you're going to have 3 to 5 machetes to take some huge slashes to your taxes, and then you're going to have basically 20 plus steak knives. And but
Okay.
you're compiling them up to have a cumulative overall effect of reducing your tax liability.
Okay.
Like one being is like, do you have the proper entity structure in place, depending on the type of business, especially if you're running an active business making ordinary income, all right, if you're netting over $50,000 a year, are you an S corp? Why haven't you switched to an S corp yet? And that's key there, because you're not just hit with your income taxes, you're also hit with uh, FICA taxes as well,
Yeah.
your self-employment taxes. So
Yeah.
that aspect of that additional 15.3%, not just hitting your bottom line, could be huge, because that's how people go from being taxed on 40% of their income to being taxed over 50% of their income with just that there. So just, is it the time to rush, get that 2553 form filed so you can get the S corp election in place, get a last minute payroll ran if possible, so that hey,
Yeah.
you're now able to save thousands of dollars on just FICA taxes for just doing that. Like I said, but depending on the state you are, you may have corporation fees associated by running a S corp or corporation in your state. Are you going to run your own payroll, or someone else going to run your payroll? If you're paying for another tax return. So it's just knowing the different fees and costs, and that's why I mentioned $50,000 net earlier, because roughly at that point, that's where the tax savings can start outweigh the cost associated with it. But also, so like, it's just being mindful of that, especially if you're a W-2 employee as well and running a side business where it may not make sense, because your employer priority taking up quite a bit of the Social Security portion of the FICA taxes. So it's just taking a holistic view of everything in place. Okay, am I really saving by making this election, or I'm just creating more hassle just to break even, or just end up upside down because I'm paying more in compliance costs than the actual taxes.
Okay. Entity structure, number one. Is there cost savings, machete options available to you? Is that fair?
Right.
That's not a steak knife, right?
That's a machete.
machete.
Yeah.
Okay. That's a machete.
We
Huge
get
splash.
tens of thousands of dollars. We're talking about in the machete range at that point.
And to be clear, you can change the election of your business right down to the last minute of the year?
So typically, this is 2025. The due date of making the election from LLC to a S corp or C corp to a S corp is March 15th of the same year, 2025.
Okay.
However, they do allow some grace period within the calendar year. You just have to make sure you already have the LLC set up already.
Okay.
Like if you're just now trying to open up the LLC and then try to S corp election in December, you you cannot claim that you've been operating as LLC all year, so you only get the tax benefit for just the month of December, not all of the whole year. So it's good to know, like, hey, do you already have the LLC set up for asset protection purposes? Because LLC do not help you save on taxes. It's just one step to potentially, if you're running a business making ordinary income.
Okay. Perfect. All right. Slash number one. Machete number one. What's machete number two?
Machete number two, we're back with 100% bonus depreciation. So I know everyone's been clicking heels since July 4th of this year, and now it's kind of taking a step back. Like, hey, if you did acquire a rental property, whether long term or short term, and that does depend on real estate professional status and all that, but do you now have the opportunity to get a cost segregation study done for that property, get that depreciation accelerated more into 2025 and offset your other income with those losses? So you have that as a benefit, a huge benefit as well, because we're seeing people 20, 30, 40% of their purchase price going towards 5 and 7 year property, 15-year property that qualify for bonus. That creates huge deductions at that point, as well as this is where you get into the Section 179 with your vehicles or any type of, or also any equipment that your business equipment as well. So like, even if you're buying with debt, you're able to claim more of a larger deduction, or claim the whole purchase price as a deduction, even though you may only spent 5 or 10% down payment on whatever business asset. So bonus depreciation, being back at 100%, huge opportunities for people who did buy equipment or property during the year, or may have some few dollars to be able to spend on equipment these last 30 days. Like I said, if you're positioned to buy rental property in
Yeah.
December, like good for you. It's just whether or not you can get it rented out at that point.
Yeah. Yep. Okay. Cost segregation. My takeaway. Does it work unless you have a renter?
You have you have to be placed in service. So it's like, hey,
Okay.
do you have proof that it's on the market, ready to go? Um, but you may not have gotten anybody in. That only is going
Okay.
to work for your long term and your mid term rentals, and
Okay.
which is why that's important because if you're not able to claim real estate professional status, or in other
Hmm.
terms, you didn't spend more than half your work time in a real property trade or business, you're
Yeah.
not able to use those losses anyway. But if you
Yep.
do, or if you marry and your spouse does, or you have other passive income to offset, whether
Hmm.
you've been like in the fund or syndication that's paying out, or just cashed out per se and send out capital gains. Now you can use that to help offset your other passive income. Now, if you have
Perfect.
but it doesn't work for short-term rentals because you have to prove that the average stay is 7 days or less. The,
Yeah.
the IRS automatically assumes the rental property is going to be passive and long term.
Hmm.
So the only way you can prove is that you have at least 2 stays. So it
Yeah.
doesn't work. It doesn't work with the short term, but long term you can. But you want to make sure you have the right income to offset, or you or your spouse can qualify as a real estate professional.
Perfect. All right. That's machete number two. You have another machete, or are we down to the steak knives? We're still macheteing?
I mean, well, I'm about to say family involved, but you really like your medical deductions can
Okay.
really play a huge role. But they have steak knives and machetes
Okay.
associated with it there, where it's like, hey, do you have health insurance premium payments?
Hmm.
And we kind of the potential fear of that going up next
Yeah.
year significantly. So that can be a huge benefit as a above deduction line item as well. Health reimbursement arrangements that you may have with your
Hmm.
business as well to get that documented and set up so that basically, like I said, you're basically paying yourself back
Yeah.
for any medical costs that your business is paying for there. And then so you got your high deductible HSAs, whether you have it through
Hmm.
your employer or you can get one set up. I know I mean, there may be some people still will open up open enroll period at
Yeah.
this time in December. You may still be able to get into one of those. But yeah, so those are your kind of your options there. We're talking about kind of
Okay.
medical expenses as well as like you're running like a larger business,
Yeah.
group term life insurance stuff like that. Where it's like,
Hmm.
hey, like you're especially aspect of like kind of keep employees and all that, so you can keep high quality talent as well if you're offering those type of
Absolutely.
benefits
Absolutely.
to your team.
And you are seeing that there are more and more employers out there that are starting to come back to offering more benefits than they were previously. And I think a lot of that is just because of the turn that we're kind of seeing a little bit on the remote employee, where the benefit was you didn't have to come to work. You could work from home. And the reality was is they started cutting on the healthcare benefits and the benefits they were providing remote employees.
Hmm.
And now that when you bring them back to the office, it's ironic where now all of a sudden the employee's like, well, wait, I need health insurance again. It's like, you're right, because now you're working with other human beings. You're sicker frequently. You're
Yeah.
needing to use your health care. And so it's kind of pushing up to, employers having to go back to offering some of the or paying for some of the costs of the healthcare. And so it is kind of interesting. It's definitely increasing the cost to businesses to retain and obtain the quality employees that you're talking about. So I can see how that could be a machete for sure.
Yeah. Yeah.
For sure. We
Especially
all know that
when
those
you're
costs aren't cheap.
not at all.
Yeah.
Then like I said, a final machete people you could look into is retirement accounts. Now I know your IRAs at the 7,000 and 8,000 if you're over
Yeah.
50. Those are your kind of like your steak knife. But really the big
Hmm.
piece is like, hey, if you are like solo 401k, if you're just a
Hmm.
solopreneur or you're running a business by yourself, that aspect
Yeah.
of being able to get up to $69,000 And deductions is a huge play,
Huge,
and the
yeah.
aspect of you're making $23,000 of it as an employee.
Hmm.
If you haven't made any contributions, you got 30 days to do so.
Yeah.
But also being able to reassess what the tax return may look like, and then make your
Hmm.
employer a contribution in 2026. So,
Yeah.
so that's what the other $69,000 can come from there to kind of add into that bucket. So, solo 401ks is a rather huge benefit. If you obviously don't have any other full-time employees, if you got
Yeah.
part-time, you could. But if you
Yeah.
do, then you're looking to more of a simplified uh,
Hmm.
employee pension plan or
Yeah.
employee pension. So you have that as an option, but still, the aspect of getting like 25% of whatever W-2 wage that you're paying yourself, or 20% if you're self-employed. Once again,
Yeah.
another huge benefit there. And then
Absolutely.
lastly,
Kind of it
I'm
kind of
sorry.
layers it though, right? I mean, it kind of layers it because one thing I think that is kind of a myth, and maybe you can demystify this a little bit. Let's say you are a W-2 employee and you are contributing the max to your 401k plan, but let's say you're also a business owner
Mm,
and you're kind of playing, double duty here. And there's a lot of us out there that are. Um, are you able to contribute to your 401k plan, your SEP IRA, and make a contribution to your Roth IRA?
yes. So the difference is that the employee portion. So that's the key there. Was like, hey, it doesn't matter how many different jobs or
Mm-hmm.
other businesses you're running. You can only be an employee once, and everyone's capped at the
Mm-hmm.
at the 23,000
Yeah.
at that point. So then it's like, hey, well, you may, and we deal with a lot of high W-2
Mm-hmm.
employees, quarter of a million and up. So like they're already kind of maxed out that part, but they're running this other business. Okay, well now we're only talking about the employer contribution to it as well, and depending upon the net income of the business or the W-2 that they're paying themselves, we're
Mm-hmm.
now just also trying to figure in, okay, well, let's just do some backdoor Roth conversions since we already kind of maxed out what we can from a deduction standpoint. We might as well just go ahead and start putting stuff uh, that non-deductible traditional, and then rolling that
Yeah.
into your Roth.
Yeah. Absolutely. So lots of strategies. I mean, really,
Yeah,
it's again, it kind of goes back to knowing your client and kind of figuring out all the avenues that they're uh, charting down in order to figure out where the machetes and the steak knives are to come
yeah,
out. Okay.
yeah. The end goal is to move everything in the Roth at some particular point, whether it's 401ks or IRAs or
Yeah.
even HSAs. But it's okay, where can I get the deduction now? And then in a year where I may not have as much income or I may have more losses, that'll be you to start
Yeah.
trying to convert some of those
Yep.
funds
Start
over to
moving it.
Roth and start having that future planning as well currently.
All right. Great. You
Um,
got another one for me?
Yeah, and then defined benefit plans.
Okay.
Another one that's kind of a lot of people don't know about because it's the contributions vary so much because it depends on your
Mm-hmm.
age, your income,
Yeah.
the type of benefit target. So there's not really like a set amount. But like I said, we've seen people being able to put six figures into a DB plan and get a deduction from the standpoint there. So like I said, if you're really running a highly successful business because they are costly to set up, was like that is a huge option to kind of put money towards the future with a plan like that.
Absolutely. Absolutely. Totally makes sense. All right. You got anything else? You got like a butter knife in there for us or something?
I mean, your butter knives, your steak knives. I mean, you're really talking about like obviously people get into like, hey, do I prepay for 2026 expenses now? Once again,
Yeah.
it all starts with what the financials say. Like, do you have the cash flow to
Hmm.
come in and start prepaying stuff now?
Yeah.
And kind of so like, which it could be helpful. And okay, when you don't have deductions next year, but then you kind of this whole new cycle of
Yeah.
paying for these new expenses at the end of the year. You got people that's deferring income until the next year, where they may defer a
Hmm.
sale of an asset until the next year, so they can't
Yeah.
be adding any more additional income.
Timing is everything, right?
Right.
Plan
And
accordingly.
yeah, and getting the family involved. So that
Yeah.
aspect uh, of family members on your board per se, and having that documented. So like, hey, Christmas is coming up. We're gonna have a board meeting, and I'm not saying you're serving Christmas dinner at your board meeting, but it's all about how it's documented. Like, do you have
It
the
is.
minutes in place, and are you documenting all that, and does everyone kind of sign off to what's going on here, and have they been a board member all year from that standpoint there? So that's the opportunity there to kind of get family members involved. We talked about your like spouses being potential real estate professional if the main spouse is working and running a business. Okay, cool. That was an opportunity to leverage the depreciation that we talked earlier, but do you have to
Yeah.
get a spouse involved? If you have kids, all right, let's put those little buggers to work now. Like, what have they
That's
been
right.
doing all this time? And have they started getting them more involved in the business? Where it's like instead of paying them an allowance, you're
Yeah.
paying them for services, and then if they're below the federal standard deduction and whatever state you're in standard deduction,
Yeah.
then you're not having to withhold FICA taxes. I mean, you don't have to pay them a W-2 or a W-2. You're not 1099 them, but
Yeah.
and then they're not required to file taxes at this point. So it becomes an income shift from you to
Yeah.
a lower income bracket for your kids, where you were paying them money anyway. You was buying them
Yeah.
stuff anyway. Let them buy their own stuff.
And that can add up. You got a Brady Bunch going on. I mean, that can significantly add up. Now, the thresholds are usually much smaller, obviously.
Right.
But I mean, you got 3, 4, 5, 6 kids at $1,500 a pop. It does add up. It
Yeah.
definitely adds up to what we're talking about here.
Yeah. And
All right.
people get into like what type of work can they do, and it's like, man, it depends, age appropriate, and then if you was paying somebody off the street, so yeah, like if because that's where it comes more of a family discussion, where it's like, yeah, you got a 1-year-old daughter, she's not climbing on the roof nailing down shingles. Like maybe I'm not in everyone's household.
Maybe.
So,
She
yeah,
could be strapped to
can't.
your back. Who
I
knows?
got no judgment on stuff like that. It's
Yeah.
completely fine,
Moral
but
support.
most likely, is be more marketing. But
Yeah.
you have couples that like, I don't want to just put my child out there for marketing reasons. There's no wrong answer. Like that's
Yeah.
an appropriate answer for that family. And
Yeah.
so just understanding that like you lose out on that type of stuff, but it's for a greater good, not just for a tax deduction.
Absolutely. Absolutely. All right. Makes sense. All right.
Yep.
Is there anything else? Any other last minute, like machetes, steak knives, butter knives?
Well, we're in the holiday season, so now it's like, hey, everyone having their little house events. So now
Yeah.
now they're turning their house events to business events. So now you're talking
Mhm.
about the Augusta Rule, where you can
Yeah.
rent your home to your business for up to
Mhm.
14 days, and along the rents are at market rate. The business get a deduction, and you
Yep.
personally don't have to pay. You don't have to report that income because you're below 14 days. So
Yeah.
people are just kind of like having their random events. Like,
Okay.
we do it once per month, and then double it up on on November and December. But like that's the strategy that we implement from there, and we know what the rates are per event spaces nearby, and we got
Yeah.
documented from there like what was going on in that event. So it's just like I said, it's something like that is still useful, especially talking about like 4 figures per
Yeah.
per use. That if it's 1,000, that's 14,000 is a huge deduction for a lot
Yes,
of
it
people.
is.
And then after all of that's
Okay.
taken into consideration, we bought every single thing that we can buy. Then we can talk
Okay.
about estimated tax payments. Like, is it worth now to make an estimated tax payment if it's going to prevent a penalty per se?
Yeah.
And then, like I said, part of that is assessing, okay, what was your tax liability last year, and then what you supposed to be paying this year based off the ups and flows with the business. So it's just taking all that into account. But like the very, very last thing we want to do is pay the government.
Absolutely. No, I totally hear you there. All right. Well, I think we covered a lot in this segment of last minute tax savings. And the one thing I'm hearing from you, Larry, is every situation's different. And unless they have an opportunity to sit down and really talk to you about it, I can't imagine some of the things that that people can do given their specific situation, and suggestions that you may have to add even more tax savings to their specific situation. We're just talking machetes and steak knives here, but there could be more.
Yeah,
So,
like it is personalized to each individual. There's no cookie cutter to any of this.
absolutely.
It's a starting point. Social media
Yeah.
doesn't help with that at times.
Yeah,
But it's just
sure.
taking this clay that social media put out there, and then how do we mold it to what to this actual person needs.
All right, Larry, thank you so much for the machetes and steak knives of tax savings. We'll see you next time on The Preferred Way, where we're going to start talking about you gosh darn procrastinators out there making our lives harder. But until next time, Larry, we will see you on The Preferred Way. Thank you so much for joining us.
Thank you.
Thanks for joining us for another episode where retirement savers meet alternative investments. Can't wait for the next episode to learn more? Visit our website at preferredtrustcompany.com.